Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything investment related, or personal finance related, I should say. It's not just investments. It's also about how you spend money and how you apportion it so that you can meet your long-term goals. And to that end, we sometimes bring you the people who manage your money so that you can understand what their perspective is and you can set your own expectations, not for the next 1 or 2 months, but for the next year and few years in all probability. Join me at the start of this program is Dinesh Balachandran, who is the head of investments at SBI Mutual Fund. Dinesh, thanks so much for taking the time and pleasure speaking with you. I want to start on a very interesting note, I think, and I want to get your perspective on this because we may be, for the benchmark Nifty 50, about 500 points away from all-time highs or thereabouts, give or take. But at the same time, you have a lot of people that have been posting on social media telling us as well, don't be so happy or don't celebrate the benchmark hitting all-time highs because our portfolios have not done anything over the last 1 year. What do you make of this dichotomy?
Yeah, first of all, thank you, Alex. Thanks for having me over. With regards to this particular situation, I think people need to zoom out the lens a bit, right? Because when you think about the broader market and think about what has happened over the last 5 years, ignore the last 1 year part, but if you look over the last 5 years, the last 5 years have been really, really good for the broader market, right? Where there are so many stocks that have essentially become multi-baggers over this period. Now, when you think about equities inherently doesn't work in a linear fashion. It is not like a fixed income security where you get the same interest every single year. You will have periods where the returns turn out to be much better than what you thought. And then you're going to have phases where the returns are going to be much lower than what you thought. But if even including the last 1 year period, if I think about the last 5 years, the last 5 years have been extremely good for equities. And in fact, the first 4 years were so good that there was a lot of valuation froth in many stocks in the broader market. And the last 1 year essentially has been about removing some of the valuation froth. So there is nothing really unusual or untoward happening here. It's just that people have to think about a proper time horizon while evaluating equities in general.
That's a fair assessment. Now, if I speak specifically, Dinesh, about your Contra fund, which I think a lot of people look to, right? Because the idea is that you make hay when there are doldrums or where things are not looking particularly good. That's where you pile in selectively. Before we speak about some of those strategies and how they've played out over the last 1 year, has it been more challenging than it has been in the recent past to pick stocks from your perspective?
Yeah, let me give you an actual example of what has happened in the fund. If I just go back 12 to 15 months, we were essentially looking at a situation where the inflows were obviously pretty strong, but we were having challenges in terms of picking the stocks that we want. When I say picking the right type of stocks, I'm talking about stocks where we would want to have a basic hygiene in place and stocks where we would want at least mid to high teens sort of return expectation embedded in them from a entry point perspective. And there we were really, really struggling because there was so much froth in the market where there were so many stocks that essentially were at very high valuations compared to historical norms, compared to the growth expectations, that it was a real challenge, right? And that is why I'm saying that when I think about what has happened in the last 1 year, it really has not been a big surprise because it was such a challenge to find good opportunities a year or 15 months ago. Now, when I think about what has happened over the last 12 months, a lot of that valuation froth is going away. So is it a better situation today as we speak? Absolutely. Even when I look at the cash levels in Contra fund, the cash levels in Contra fund went to the maximum extent possible. In Contra fund, we actually have a 15% leeway for holding on to cash. We took that decision 15 months ago, not because of some macro call, but more because we were just having trouble finding good opportunities. That cash level is coming down steadily, where today, particularly when I think about what has happened even in the last few days, it is frankly speaking feeling much better So we are deploying as we are finding investment opportunities.
Roughly, where does the cash position stand at right now for the Contra fund?
Right now, it would be close to around 8%.
Okay.
And it's coming down.
It's going down.
Yeah.
You know, the last time we spoke, if I remember correctly, if my memory serves me, Dinesh, we were speaking about the Contra fund. We spoke about how the broader markets might have actually surprised you on the upside, where they were underperforming at the start of the year, and very quickly they came up, and so you weren't able to deploy as much.
Yeah.
That situation is changing as we're speaking right now?
Yes, clearly. Like if you think about what has happened, particularly over the last month or two, it is very clear that valuations are coming off in many stocks in the broader market. So to that extent, it is essentially feeling better, no doubt about it.
Okay, so part of why I like to speak to people such as yourself, Dinesh, is because it helps my viewers and your investors set their expectations for the time to come. And so from that perspective, you're saying things like it's looking better now, and you're more confident now, you're deploying now. Should they interpret that to say that the next 12 months are likely to be significantly better?
Yeah, one, clearly, at least I don't have a crystal ball where I can exactly
Fair enough. Fair.
Directionally. But let me put it this way. When I think about, again, going back a few years, in 2020, 2021, and even 2022, was I inherently much more excited about markets? The answer is yes, because it felt like there were so many opportunities available that it felt like, if you just do your job well, you're going to get amply rewarded. By the time we came to 2024, that situation had completely gone away, where we were essentially having trouble even finding stocks where we wanted to meet our basic cost of equity threshold, right? And that is why we decided to stay in cash. Today, is the situation better? Yes. But is it anywhere close to where we were in 2021 or 22? Absolutely not. We haven't reached that kind of valuation comfort where we can say that, oh, I'm very excited about equities. I honestly can't make that kind of assertion. But is it better than where we were 12 to 15 months ago? Yes. And then if I am thinking about it, as long as people's return expectations are a bit tempered, when I say bit tempered, I'm talking about, if you think about nominal GDP expectations, the equities over time, broadly speaking, should be a little bit better than that if you're doing your job properly. And if that is the kind of expectation that people have, I think we should be able to deliver that.
Yeah,
because I think...
But Dinesh, we're speaking at a time when nominal GDP is at 8.8% or 8.7%.
Okay, all right. Let me talk about the nominal GDP expectations that were there before the latest prints came in.
Yeah. Okay. All right. So that was going to be my next question, which is, we've had over the last 1 year more than usual this ongoing debate about the deviation between valuations and earnings. And you said the exact same thing that a lot of people are saying, which is this has been a year of catch-up, where in the last quarter, in the second quarter, a lot of companies did post better than expected numbers. But that question still arises. Is this inflation print and what it means for nominal GDP bothering you or worrying you at all? Or would you focus more on core and say, okay, core inflation is still above 4.5, maybe a certain extent to us. I don't know how much you look at macro, but I'm just wondering, and of course you're bottom up, but are you bothered or worried that earnings will not necessarily take off as dramatically as some people anticipate?
Yeah, I mean, when you look at it, there is a relationship between nominal GDP and aggregate company earnings. Yeah. So if you believe that nominal GDP is essentially going to be less than 10%, that's a real problem at the end of the day. So you can't wish that away. The only question that we've been sort of like discussing or we've been asking ourselves is that to what extent the nominal GDP prints that we've seen over the last 2 quarters are indicative of what is ahead of us. And there, our take on, our take on it is that we think that this print is going to sort of become better as we go forward. because what has also happened in this interim time period is that government has come out with certain policy actions, right? So when you think about the GST rationalization, that in some sense is a response to the slowing down of the economy. And so then when you try to project going forward, you also have to incorporate the positive impact of such a policy action. Not to mention that this year also has been marked by a lot of uncertainties on the external front. So you also have to ask yourself if you believe that some of those uncertainties are going to go away or at least get mitigated going forward, what does that mean for nominal GDP and hence company earnings? To that extent, we are more optimistic going forward than if I have to only look at the economy from a rear view perspective.
Interesting. I also want to ask you your opinion on primary market action, because there's so much that's been said in the recent past about the valuations of companies coming through. And I know I've read an interview where you've said that just simply stating valuations are steep is a little simplistic, that you got to look beyond one or two metrics to judge. And you've participated in some of these anchor books, in maybe not the Contra fund, but certain other schemes, right? And there is a reason why you believe in some of these new age companies, which other people say are expensive, and they've proved to have been remunerative. So explain your thinking.
Yeah, I think what is happening is that there are business models that markets have sort of understood over a long period of time. So when you think about a basic financial company, I think this is a business model that market participants understand very, very well, right? So it is very easy to sort of put a valuation range around such companies because you know how these companies have historically behaved, and you can make a reasonable guesstimate in terms of what they will do going forward as well. But what is happening is, particularly with the new age companies, you don't have a long track record of listed companies in this space. And to that extent, a lot of market participants are sort of inherently they're trying to figure out how to think about such companies. On top of that, you also have this basic issue that they are loss-making. Many of them are loss-making right now. And like the valuation guru inside all of us inherently frowns upon loss-making companies. And so one can easily make an assertion that, hey, you should not participate in any such company. But it's not that simple. This is my point. Because you have to ask yourself, if a company is loss-making, is it because of structural deficiencies in its business model? Or is it an active strategy in order to sort of have a very robust growth in place? And because the robust growth also brings network effects and other sort of like synergies into play, right? So you have to ask yourself, is this company as such inherently profitable from a unit economics perspective, but is reporting losses because of a conscious strategy? One, that is something to think about. Two, valuation often is a function of the growth runway. It is a function of how confident are you that a particular company can continue to do quite well. And this, for a new age company, as I said, it's a less discovered, less understood sort of process because we don't have a long history. And this is why there is such disparity in thinking, such disparity in terms of analysis on such companies. We think, now obviously I'm going to sort of tout my own in saying that we think we have a good handle in terms of how to analyze such companies. So wherever we see comfort, now particularly someone like me, I tend to focus a lot on valuation. I mean, Contra fund inherently thinks about margin of safety. It inherently thinks about valuation comforts. So I'm not a momentum guy where I will participate in something just because it happens to be the flavor of the season. But even for someone like me, I see merits in investing in a lot of these companies because...
So let me ask you, let me ask you this. So therefore, I mean, it would be wrong to look at a company that's just hit profitability and to look at a price to earnings multiple. That would be a little foolhardy. So therefore, from that lens, when you're looking at valuations and you're judging, would you look at a combination of, say, the total addressable market? You look at various other factors, and that gives you more comfort. So it's not pure valuation then.
Yeah, it is valuation as captured from a DCF methodology, where you are essentially trying to think about what this company looks like over the next 20 years.
Yeah.
Obviously, the further out you go, you also have to be realistic enough to say that, I don't know enough. I don't have a crystal ball. So you have to make some conservative assumptions there.
Yeah.
But even if you do that and you are able to sort of justify the current price, I could care less about whether the company is loss-making this year or not. I am much more focused on the inherent business model, whether it is robust or not, whether the company has unique positioning, and on a DCF basis, without making very aggressive assumptions, am I able to justify the current market cap or not?
Okay. I'm going to try and run through a few questions very quickly, Dinesh, if you'll allow me. We've got about 2 minutes left, right? And this I'm hoping will capture quite a bit. So one, in your balanced advantage fund or in your hybrid strategies where you also manage equity, are you more aggressive or more allocated towards equity than you were 1 year back?
Absolutely. Last year it was 30%. Right now it is close to 60%.
Fantastic. Okay. If I were to ask you, in a falling market, would you be in the top percent? Not would you prefer to be in the top percentile, that is falling much less than the market? Or in a bull run, would you prefer to be in the top percentile? Which one would it be?
Oh, that's an easy one. For balanced advantage, we really
for
care
equity,
about
for
the
you,
downside.
for equity.
Yeah, okay. So for the balanced advantage fund, the equity component also, we really think about downside. So in a hybrid fund, we are very, very conscious of the downside.
Yeah.
So for me, falling less in a downward market is very important. Even when I think about the pure equity schemes that I manage, I think it's very important to sort of not be so aggressively positioned that you are sort of like left very vulnerable in a bear market.
Fantastic.
That is something I think about all the time.
Okay. And the last question, which is kind of talking about your flexi cap strategy, which unfortunately we've not spent too much time talking about. Are you less orientated towards the broader markets than you have been in past times? And are you likely to shift that, anticipating that the broader markets will catch up over the course of the next 1 year?
Yeah, so this was a conscious call a year or so ago when we thought that there wasn't much in the broader market. But looking at the way it is evolving, I think we are now going to find more opportunity in the broader market. So the orientation where it was sort of moving away from broader markets might again change going forward. Inherently, Flexi Cap is basically a fund where it's a function of the opportunities available out there. If the opportunities are more in the large cap space, we will go there. If the opportunities are more in the small and mid cap space, we'll go there. That is the basic thought process.
Absolutely, and that's why the conversation that we've had is going to help your investor, in my view, understand what the path ahead looks like, possibly. And I understand that you don't have a crystal ball. Thanks so much, Dinesh, for taking the time. Pleasure speaking with you.
No problem, Alex. Yeah, same here. Thank you so much.
All right.